Welcome to the Asset Revolution podcast, where we discuss the revolution and evolution of financial markets and infrastructure brought on by blockchain technology. I'm your host, Marc Nichols, financial advisor turned blockchain and digital asset pioneer, where I serve as portfolio manager and head of product at Arbor Digital, an alternative asset manager committed to the emerging digital asset class. My guests today are Jörg Willig and Martin Leinweber. Jörg's career spans over 2 decades, where he served in key roles at high-ranking asset management institutions, including Germany's largest quantitative asset manager as head of fixed income markets. Jörg is currently serving as a director of portfolio management at Distinguished Private Bank, responsible for managing funds for both institutional and private clients. Martin's 20-year career has seen him hold executive director and portfolio management positions at Quonium, where he also furthered many international ventures with MEAG. He now serves as digital asset product strategist at Market Vector Indexes, a European regulated index provider known for its pioneering work in the digital asset markets since 2017. There, he oversees product development, research, and thought leadership in digital assets. Martin and Jörg co-authored their first influential book, Asset Allocation: MIT Crypto Assets, under Wiley Finance in 2021. This book charted new paths for integrating digital assets into traditional portfolios. Their highly anticipated second book, Mastering Crypto Assets, also published under Wiley Finance, is set for release on January 24th, 2024. Now today, we dive into this book, and we discuss and make clear the critical links between accepted principles in conventional finance and how they can apply to crypto assets, as well as their differences. We also answer the challenging questions of crypto asset valuation, crypto allocation strategies, and how blockchain is introducing an evolution of trust in global financial markets. Now, before we begin, while I am a licensed advisor, I am not your financial advisor. Nothing covered in this podcast should be considered investment or legal advice. All information and intelligence born from this podcast is meant for education purposes only. And now, my conversation with Jörg Willig and Martin Leinweber.
And Jörg, I'm going to start with you first. Take me through your traditional background and then what led you into this wild industry that is digital assets.
Yeah, I studied business informatics in Hamburg in Germany, and then went to my first job in a bank in the asset allocation business. I then moved on to different banks in the fixed income space, derivatives, and I've always been interested in these more complicated financial products. I really like them. And due to the background in informatics, I just, it was a natural way to become interested in Bitcoin and cryptos, because first from a technical standpoint, and then these mixture of technology and capital markets just lured me into this topic.
Well, you use the word lured. What is there anything specific that comes to mind when you were lured besides those things you just mentioned?
It's a way, it's a kind of a monetary system out of the system, you know. It's just what many people are interested in. It's just how can I get part of my money out of the system to be safe, just in case something big happens. And that was really the big question. I wondered, could this work? How could this work? Because many tried it before. And with Bitcoin, it seemed possible that it may work. And so far it does.
And I love that. And that's one of the things I'm going to really enjoy about this conversation is we're going to take more of a global perspective as to the why and what the purpose of Bitcoin and blockchain technology is. So thanks, Jörg. I appreciate you going into that. So Martin, I'd love to hear your traditional background and kind of your journey into crypto now.
Yeah, I would say I'm a classic TradFi guy. Yeah, so I studied economics and worked also for many years in the asset management industry. And so for a relatively long time, I didn't have any clue about Bitcoin. But Jörg and me, we were colleagues, and so one day he was setting up you remember our Bitcoin wallet for me, and just sent, I don't know, what did you send, $10 or so?
10 Bitcoin or so.
It was in 10 Bitcoin, correct. That was in 2016, and I suddenly was fascinated to see how easy it is, what really it means to be permissionless, and that everybody can use it, and this peer-to-peer phenomenon, right? If you compare that with a normal account, I mean, we live in Germany, it's not hard to get an account, right? But you have to do some paperwork, KYC, AML, and then it takes several days, and maybe they have some questions and so forth. And suddenly you have the thing, and you realize, oh, okay, there's no middleman. There's nobody you have to trust. And then I got really hooked and read more about it, and was really fascinated by this Bitcoin thing, and also the whole crypto blockchain thing.
Yeah, and I think when you speak, it really hits on. It makes me think of the philosophical that comes with this asset class too, which is really a pretty heavy thing for a lot of people to take on, because it really makes you question. So we mentioned something like permissionless or decentralization. Like, these are words that aren't just, conceptual education or academic terms that you can define and accept. These are really question a lot of the philosophical things that have, created our systems that we use now on a global scale. And you really have to step out of that mindset to really be able to accept that and really start questioning and have that philosophical. Did you guys find that you also went on this kind of philosophical journey? Because I hear that a lot from a lot of, being a TradFi myself, and that's where I was traditionally born out of for my career. Did you find that you kind of almost had to take this philosophical approach when you came into this industry?
I would say it initiates philosophical thinking, although I have to say in investing, it has nothing to do with a philosophy or a conviction or a belief. So you have to be agnostic when it comes to investing. But what I like about this asset class, I say asset class, crypto, is it really makes you question a lot of things. So suddenly you also talk about what is money, and also the term fiat. I also have to be honest, the term fiat, I never heard that during my study in the university. We never talked about that. So for me, it was an Italian car manufacturer, Fiat. So suddenly you talk about fiat money. Suddenly you also talk about what is a bank. And many people still believe that the money in the bank is my bank. No, it's not your money. And suddenly you think about those things and about the whole financial system, which is really, I like it a lot. But I think dangerous thing when it comes to these philosophical questions, that you suddenly believe in it, and then it becomes a dogmatic investment. And then it gets tricky, because I think when we enter the realm of investing then in this asset class, you can like Bitcoin and you can love it and you can like the philosophy behind it, but you should still be able to sell it one day or at a certain suitable point. Because then suddenly we talk about this Bitcoin maximalism, you just hodl and everything has to be Bitcoin and I never sell it. And I think that's dangerous. But I like this whole blend of being philosophical and then talking about investing, and it touches so many points, and that makes this so interesting.
I would add that it's the main point, which is from a philosophical standpoint, which hit me, is that you don't need trust, but you still can transact, and that's really important, because all these institutions or these middlemen, they get paid for trust, and not every middleman is to be trusted, as we learned, not only in the recent years. So it's cleaning up the system. You just have transactions, and you clean this up. It's just A and B transacting without anything in between, and this makes it cheaper in the end. That makes it more secure, and it's really interesting, because you just think, how did this world evolve? I mean, to build trusted institutions, that was a big step ahead in the past, because it made trade and transactions possible, and it protected small people or any company who transacts. But now it's the next step, and it's hard for people to imagine a world where you don't need trust. I mean, you still may trust anyone, but you don't need to if you just want to transact. And that's really, really a big social change coming, I think, for better or for worse, but it will become cheaper, of course. And in the end, one more point perhaps from this philosophical standpoint is, do you still need a medium of exchange in the far future if everything is tokenized? You always say, yeah, I need a medium of exchange because I can't change 50 cows for one, I don't know, for one airplane. But in the end, if everything is tokenized, what is the medium of exchange? Everything can be a medium of exchange. You just switch token for token, and you don't need one token to be the defined medium of exchange. I really like this. Think a lot about it. Think a lot about it. Yeah.
Yeah, it's interesting. It's almost like it goes back to a lot of. It's just a evolved way to barter because you're using different
trading.
Yeah. No, I appreciate you guys going into that because especially Martin, when you talk about the dangerous side to the almost the religious, the cult-like behaviors that you see in this asset class, and that's kind of one of the things. And you guys have a chat. We're going to get into the book here in about 10 seconds, but one of in the table of contents, I was looking through this book was asset vetting, and one of the things we very early on, which we identified as one of the key factors when you're doing kind of any top-down research, was this, religious, like cult-like approach to that. Whoever the network was, how was it born, and how was the network evolving? And that was one of the dangerous things we identified in certain networks. And we saw some of those play out over the last couple of years. But I'd like to go now straight into the book. So this episode, thank you so much for joining and for bringing. This is kind of a first sneak peek into this book called Mastering Crypto Assets. And I'll just tell you, when I first read the line that you were going to release this book, because I've been following you guys from afar for quite some time and just admiring your work, as other minds in the space. It's always nice to respect that. But when I saw this Mastering Crypto Assets, I was like, oh my gosh, I can't wait to read this. And I knew nothing about it. And then we talked, and now I've read a couple excerpts of the books. So I was going through the table of contents, and one of the things that really stuck out to me was the depth of topic. Right, you go into pretty much everything you can think of when it comes to asset allocation from a traditional perspective, and that's one thing I think that's been missing actually, is a book that really, or some sort of educational resource that really goes into that thing. But I'd like to start off, take us through what prompted to write this book. What's the why behind writing this book, Mastering Crypto Assets?
I think the main idea is just to bridge the different worlds, the new world of crypto assets and the old conventional investment world. And if you want to understand crypto, what is good and what is bad, you have to understand the fundamentals. So we couldn't leave out the fundamentals. And then you have to look at the risk return profile and have to compare it to other asset classes, just to give people a chance to grab the concepts and to think, not to think it's a scam, it's a get rich scheme. It's a new asset class, like it or not, and that's what we want to convey in our book. And it's really written for, I hope you see it on the same angle, it's written for private investors, for asset managers, and it's just groundwork. It's a handbook, really.
Yeah. Also, I have to say, when you meet people, very often it's black and white in crypto. Yeah, so either you are a crypto degen, 100% invested in crypto, and you'll be a part of it, or you'll meet the more boomer-oriented TradFi guy who says, "Oh, I hate it. It's a scam. Yeah, 0% allocation." And we also like other asset classes. And I think what's missing, if you look at crypto books, it's a lot about why Bitcoin and crypto standard and what have you, and what is Ethereum and all that stuff. But I really do think that this asset class belongs into a multi-asset portfolio. And how does it behave? And that's maybe also reflecting our background as an institutional portfolio manager, because when we talk to our clients or colleagues, they mostly said, "Oh, I have no idea," and it's a scam. And then people still think I made a mistake, that I am totally focused on digital assets, right? And don't understand that. And so I think a book, although it's an old-fashioned way, yeah, to do it. But in order to be facts and figures oriented, in order also to reach out to the right people, I think it's a good medium, right? Because think of it, a lot of institutional or professional investors, they don't go to Discord channels, yeah, or they also don't like crypto Twitter and all that stuff, right? And so we thought that's maybe then the best way to engage these kind of investors. Yeah.
It's the book we missed when we started out, I think. It's just
correct. Yeah.
serious information, no marketing. I mean, it's just facts, and I think interesting facts from both worlds.
I love that line. It's the book we missed out when we started. We missed when we started out. I think that's going to live on beyond this podcast, I think. Well, again, for me as an asset manager in the space who saw this book, and now I've had the privilege of reading a couple chapters of it, I have to say that, yes, it may be an old-fashioned medium, but I think the way it's written is really well done. And what I mean by that is that you take this bigger approach to helping go through the history and setting the stage for why this asset class could be born anyway, by going through a robust history of traditional, configuration of asset classes and markets, and, how we can trade and transact with each other, and what do the global systems look and feel like today, and what are the approaches that, all of the minds that have been in this space for hundreds of years, what did they take? Why do they exist now? And then you start to bring in people to the concepts of digital assets and why it could potentially fit or help evolve those systems, which I think is the right approach, because most of the resources you see, like you guys said, it's mostly a lot of crypto people or people who believe in the asset class, trying to convince people that this is worth something, as opposed to, and it's just because, again, it's a lot younger generations. I'm still trying to figure out how to influence and guide people along in a very disciplined way to understand that this is not just scams and people doing bad things, even though those are the people who are getting all the headlines and those are the things you're going to see in the news a lot more. There's a lot of great things happening. So that's really one thing I loved about the book. And so I guess one question that came to mind, this had to be a difficult book to write, given still how early in the life cycle, I guess, of this asset class we are, and then how late in the life cycle we are in terms of our traditional markets. What were some of the difficulties you guys ran into, and how did you approach them?
Yeah, I have to say it's already the second book. Yeah. So Jörg and me, we've written one book already in German. Yeah, it's called I translated Asset Allocation with Crypto Assets, and we started that in I think it was 2018, 2019.
Yeah.
And so the challenges of writing a book of such a disrupting and fast evolving asset class is really that when you finish a chapter, it's already old, and you can rewrite it again. Yeah. So what we've learned from our first book is, so the new book is, I would say, based maybe 20% on the old book. So we really redesigned the chapters, refreshed them. And my hope is that it's more a perspective from it's process driven, right? So of course the charts are getting old, but it's really about how to approach this asset class. Yeah. And I mean the chapters on a Bitcoin, they are classic, right? So you can say maybe that's set in stone, although one has to be careful, right? But really the way how to add a high volatility asset class in a traditional portfolio, I think that's I think timeless. Yeah, how to handle risk, and so we really try to focus more. What's the process of investing? What is a prudent approach when it comes to risk management, instead of writing what is, I don't know, the latest layer 2 technology, and then suddenly nobody talks about optimistic rollups anymore, but just about CK proofs and so forth. Yeah. So we try to avoid that, and I think that's the key.
And we wanted to focus on timeless information. I mean, not these events, but the process. The process is key. And what we kept from the old book, and I really like it, it's the history of Bitcoin, the technological history, because many people have an impression, there was nothing. And then one day Nakamoto came out and said, look, this is my Bitcoin client. Go for it. It's a new monetary system. I mean, it's not the way it worked. And they are really, really giants from information technology, really brains, great engineers and coders who developed system after system, but they still were not perfect, or not as perfect as Bitcoin is, or as good as Bitcoin is. And then came Nakamoto's invention. I mean, he just combined parts which were existing and added one next step. And this is interesting because it shows it's a serious development. It didn't fall from the sky, and it makes it more acceptable for traditional managers to say, okay, this is a piece of software that evolved, or an idea of a software that evolved.
Yeah, again, really appreciate it, because it's a similar approach we take when we try to educate, because our main clients and people who we engage with are traditional financial advisors, and they're every day, they're daily, they're not living in crypto or in emerging technologies, so they trust us and they need someone to help with translating this entire space. So one of the things that we found that's actually what gives them the greatest degree of comfort and leads them to more acceptance is really showcasing the history that distributed ledger technology, or blockchain, didn't just, like you said, didn't just come out of thin air in 2008 with this pseudonymous entity. It really was born in the 80s, right? There's a ton of engineering that has gone into this. This is not something new. It's been developed, and it's just the same thing. Like Microsoft Windows today is not the same Microsoft Windows it was back in the mid 90s. I remember I was a young kid using going into BIOS where you had to put in commands every time you wanted to use your computer, right? It's the same introduction of a system. So I love the way that you guys approach processes, and the way we try to help people think about it is as in systems. Don't think about this in the high flying or the next big thing or the shiny object. But so okay, I love that answer, by the way. And let's now dive a little bit deeper into the book about some specific concepts. So asset allocation, it's a big topic. There's so many different things to go over. So I'd like to focus in a little bit more on kind of some of the chapters that you sent over to me, which was kind of taking some of the, just what is an asset class? Like why did the asset class get here? Like what is the history of just traditional, I think you call them conventional asset classes. So take us through, just as an asset class, like what makes an asset class? Why is digital assets an asset class?
Yeah, do you start, or shall I?
I start, yeah, of course. An asset class has to be distinguishable from other asset classes. It's not two equities belong to the same asset class, and you have to look at the character of the traits of the assets consisting of the constituents of the asset class. And if you look at crypto, it's completely different in many aspects from any other asset class. It has some character traits of complicated fixed income assets, but in the end, it's really it's a standalone asset class. Then it should behave different from other asset classes. Should not be highly correlated to other asset classes, and it should contain every constituent of this new asset class. Different kinds of bonds, perpetuals, senior unsecured bonds. They are all bonds, and the asset class bonds contains all of these kind of fixed income instruments. And it's the same with crypto. And these are the three aspects that define an asset class. I mean, William Sharp talked a lot about it. And I mean, there are little gray zones, of course, but with crypto, it's quite easy because it's a completely different structure. And the main question people ask is it an asset class? But it's the question, if you say it's investable, and it has been investable before the ETF, by the way. So yeah, you can say, yes, it is an asset class. You may like this asset class, you may don't like this asset class, but it is an asset class.
Yeah, and also maybe what's interesting is people tend to think just in Bitcoin terms, without forgetting that we have maybe, I don't know, if you look at CoinGecko, CoinMarketCap, over 20,000 tokens. And those tokens are not just a copy of Bitcoin and want to do the same as Bitcoin. Yeah. But very often, especially in the mainstream media, it's just about Bitcoin and Ethereum is a competitor to Bitcoin. No, it's not. Yeah. Ethereum has a completely different use case than Bitcoin. And so does a gaming token, etc. And this makes an asset class, as Jörg said, yeah, as you also have different kind of bonds, yeah, you have governments, you have corporate credit, yeah, you have different seniorities, and you have also, I mean, you have staking now in crypto, right? You can maybe also create kind of a yield, etc. And so it definitely belongs to an asset class, and I think that's also why people are surprised to hear that. But it's not just Bitcoin. Yeah.
Yeah, absolutely. And again, I appreciate you going into that, because I think one of the things we run into a lot is you can explain and try to educate all of these things, and there has to be this acceptance layer from the human that is receiving this information to say, okay, I accept that this is an asset class. And I think that's one of the main reasons why I enjoyed the book and the way you guys approached it, and think this process-driven approach, because you clearly just define traditionally what is an asset class, what makes an asset class, and you go over those characteristics that you mentioned, Jörg. And so when you can lay it out that way and say, oh, okay, all of these things are true. Okay, so that at least now opens the mind up for now a person to accept that this could be an asset class, because you don't have to convince me of it. That's an asset class, right? And us on this call. So I guess, was that kind of in the thinking when you guys were building this, was just how do we make this acceptable? Not just can we get the intelligence out there and get it in the best way and most digestible way that's in a common language framework that traditional finance professionals will accept. Was that also like, I want to get how people can generally accept these things that we're presenting to them?
It was a bit, writing this book was a bit like answering questions we both had ourselves. I mean, it's just the question, is it an asset class? We didn't know it before. We didn't know everything we wrote because we had to learn it. And then you delve deeper into these definitions, and you decide while you're writing, okay, yeah, this is an asset class. And we found a lot of stuff we liked, and we found a lot of stuff which you can criticize, of course. We are open-minded in both directions. We don't like everything, but we're still open-minded. And one point which was very surprising and interesting for me was the discussion about the market cap and the domination. Everybody says it's not a real asset class, it's just Bitcoin and Ethereum, and then there's nothing. You say, okay, it's an argument. Let's look it up. And then we looked at the stock market, at the distribution of market caps, and you see, yes, the distribution is very, very steep. It's Bitcoin, Ethereum, and not so many influential coins besides that. But when you look at different sectors of the stock market, for example, information technology, you see a similar curve. I mean, it's also dominated by a few stocks. And if you look at utilities, it's a different picture. If you look at real estate, it's a different picture. But it resembles really the distribution of the tech sector, and that was really interesting. I mean, I didn't know it beforehand. Martin, you didn't know it beforehand as well, I think. And so we learned it on the fly, and we just convey what we learned.
That's wonderful. Yeah, one of the ways we also help people gain that acceptance is just showcasing, and this is something you learn as an advisor when you get a client who has been a do-it-yourself investor in traditional markets, and they say, oh, I take an index approach, and they show you, and they've got three indexes. One is QQQ, one is SPY, and then one is a bond fund, right? And then you show them what the actual allocation is after you take into what those go, and they see that they're very concentrated in very few names by having those, and they think they're diversified. So that's one of the things that I think is also going to be born here from as we mature in this asset class. So now I'd like to kind of take it into the next one of the table of contents. One of the biggest things that we try to answer too is the valuation question. I think that's one of the biggest hurdles You know, a lot, especially, you know, I was at a financial advisor conference recently, and one of the advisors, again, and a lot of these advisors are more traditional thinkers, and they've really grown up and built their livelihoods and their businesses over the last 30 years off of value investing, right? The Warren Buffetts of the world, and reading and digesting everything that they've espoused and put it into practice. And now we're asking them to think differently. And I think that's a big hurdle. So one of them just was like, how do you value these things? You know, I can't do a discounted cash flow model to this. You know, I can't project what earnings are because they have no earnings. You know, walk us through the valuation, because there's a specific chapter for valuation. Walk us through the process of writing that chapter.
Yeah, that's a very, I have to admit, also very tricky one, right? And right from the start, I heard, okay, you can't value it, so I can't invest in it. But if you're honest, also in the traditional markets, people are speculating with currencies. And up to today, I know nobody who can reliably forecast currencies. You have gold. You have the whole commodity sector, which is also very, very difficult to value. But nevertheless, we thought, okay, what could be the approach? Yeah, and also I think what really stands out in this book, it's not just about us. So we also interviewed some industry experts or have some guest chapters. So I think there are two perspectives in crypto. So there's one sub asset class, so to say, with tokens and coins without a cash flow. So for example, Bitcoin is a prominent one, which can be evaluated via network effects. Yeah, so Metcalfe's law is a big thing. And so we interviewed Timothy Peterson from Cane Island Research, who really does a lot on Metcalfe's law. Yeah. So just to sum it up, it's really about how many users you have and how large is the interaction between the users. Yeah. And you also can value Facebook, for example, or Timothy, for example, also values Tesla in a way, because you have a network of charging stations, right? It's very interesting. And on the other hand, let's also be again this Bitcoin thing. People think, okay, Bitcoin has no cash flows. The whole crypto universe produces no cash flow. That's also not true. Yeah. So we also talk about protocols which produce a fee, a cash flow. Yeah. And a very easy example, so for example, Uniswap as a decentralized exchange. Yeah, so whenever you transact in Uniswap, you have to pay a fee. Yeah. Now, where the fee is going, that's a different thing. Yeah, some of the protocols distribute it to the token holders, or it goes to the treasury of the protocol, etc. But also Ethereum, I think, generates, if I remember right, $3 billion annualized in transaction fees, right? Mm-hmm. That's a lot. So it's not nothing. Yeah. And certainly you can use, for example, a DCF table, yeah, discounted cash flow valuation. I mean, I have to admit, you have to do a lot of work still in order to come up with where does the value accrue for a token. I think we are still very early, but maybe one last sentence, and maybe Jörg can comment on it. We also have to compare those tokens with startups. And I think in the startup world, it's also very hard to evaluate if this startup will be the next Amazon in 10 years or so. Yeah. And so you have just to accept the fact that when something is hard to assess the value, it doesn't mean that you can't value it. Yeah, maybe you have to think a little bit about it. But these are the two concepts. Yeah, the network effect, and then maybe focus also on cash flows. And I don't know, Jörg, if I told too much about it.
Can't talk too much about valuation.
Yeah.
We added a part on statistical simulations, which is just a quantitative way of evaluating possibilities, possible outcomes. I really like that because it's just taking the past for projecting possible outcomes in the future, and this works quite well if you take empirical data. And to go one step further, you have to think of monetary systems. How is the valuation of the US dollar? If you view Bitcoin, for example, as a monetary unit, there is no valuation. It's adoption, it's supply and demand, and there is no PE ratio on the dollar or on the yen. So it's a difficult approach. Nobody asks for it anyway. It's interesting because nobody cares for it, but it's a huge asset class in a way. So I think it's like Martin said, like in conventional assets, there is no perfect valuation. Many analysts may convey the impression, yes, they have the perfect forecast, but it's, in my opinion, impossible to forecast cash flows for the next 30 years. And many forecasts don't really work in the stock market.
Yeah. A good example are the Case-Shiller Ps, right? I mean, since I would say a decade plus, I hear, oh, the US stock market is too expensive. You have to invest in emerging markets every year. Look at the chart of emerging markets. Yeah, it wasn't very profitable. Yeah, but it was profitable to be invested in the US. Yes, someday these valuations maybe will change, but valuations are a blunt tool. It tells you nothing about timing. Yeah, that you are right, and people forget that because they think, oh, I buy the cheap asset, and I surely make money. No, maybe it stays cheap. So people forget that.
Yeah, it's a bit like food. Yeah, if you find very cheap food, it may be cheap for a reason, and it's the same with markets.
Yeah. So walk me through too. Then, how do you guys think about fundamentals in the space? Because I think that's where also another thing in the valuation conversation, then it bridges into this conversation around, okay, like, so if I can't do a DCF, like what are fundamentals that I can look at? And I always love that question because that means someone's thinking deeper about it and I get excited. So walk me through how you guys think about fundamentals of these networks or protocols.
I mean, the nice thing about blockchain is that everything is immutably protocoled on the chain, real time. Yeah. So what I said, the fees the protocols generate, or the users they have, the transaction volume, everything is real time on chain, and you don't need an auditor. Yeah, you don't need to wait a quarter and then you have to have one of the big fours auditing it. Yeah, it's okay, maybe not. Yeah, you have that on a block by block basis. Yeah, so you can really say you have a financial statement on a real time basis. And so I think one has to be creative about which ratios are meaningful or not. Yes, for example, we've created an index. Yeah, so Market Vector, where I work, we've created an index based on fundamentals. So we look at on-chain fees, which is for us basically indicating what is the product market fit. Does a user really attribute value to the protocol and is ready to pay a fee? Yeah, and also it goes back to the network effects. I think it's really worth looking at what is the user traction, what is the user interaction, right? Also, I can imagine developer growth, something like that. Yeah, you have several stakeholders in the protocol. Yeah, you have the protocol, you have the developers, you have the users of the protocol, and we are just at the beginning, I have to say. Yeah, but I really like on-chain data, and I also like price. Yeah, I mean, I still believe that everything is in the price, and you can also do a lot of strategies which are just price driven. Yeah, when you think of momentum, for example.
There's another parallel to the conventional world. It's just there are many fundamentals and many data points, but you still have to take care to view at it from the right angle. If you look at staking rewards, for example, you see high numbers. You see 10%, 14%, but you always have to clean it. You have to look at inflation. If inflation is 15% in this token and you earn 13, you earn a negative 2% rate, and that's interesting. Many people neglect it because the numbers look so high, and the same in the conventional market. But the data is there. It's on chain. It's available for anyone. So this is really a step forward.
Yeah, and that's a good point with the inflation, because people complain about it. But I think it's also comparable to startups again. If you look at a startup, what is a startup doing? Constantly issuing new rounds of equity. Yeah? You have the different seed rounds, etc. So what is the fully diluted valuation of a startup? It's almost infinity, right? And I think it's similar to crypto tokens at the beginning, but it's more visualized. Yeah, it's liquid. It's traded on the market. The startup doesn't. And so suddenly you read a lot about fully diluted valuation. And I think that plays a minor role at the beginning of a token. Yeah, don't get me wrong. In the grand scheme of things, it's important. But I think it's nothing else than a normal startup business where people also they think less in terms of fully diluted valuation. Yeah.
Mm-hmm.
I think dilution is key at the beginning, right?
Mm-hmm. So I'd like to go into now specific allocation strategies, because that was one of the more enjoyable sections for me too, because we have, when we were building our multi-asset strategy, back in 2019 and thinking about, how does this look? How can we bring this to life? That's in a similar way that we've brought other multi-asset strategies in equity markets. Or we take this stage that this is liquid VC investing, right? This is the first time you can do this. So that's kind of the approach we took back in 2020. So you're affirming a lot of different things. So when you think about what are the different asset allocation approaches for digital assets, because I think that's matured over the last 3 years significantly. And you go over multiple approaches that you could go through. Just to list off a few, you go through the bearable loss method, the global market portfolio, very interesting. The Markowitz method, which is very adopted here in the US, especially with a lot of the education programs adopting modern portfolio theory, CAPM, the capital asset pricing model, things like that. Risk parity approach that you put in. And then you have this, the 1 divided by n approach. So I'd like you to walk through, maybe just talk a little bit about these different approaches. What do you see actually being adopted now? What do you think are going to be the ones adopted more in the future?
I think the first method that will be adopted is the bearable loss method. Sounds very complicated. It's just invest as much money as you may lose without getting into trouble. And I think institutions, for example, may invest up to 0.5 percentage point into Bitcoin. Some will do 1%, some will do less than 0.5 percentage point. But it's an interesting method because it's like investing in alternative assets or in startups, as Martin said. It's a good approach. It's very simple, but simple doesn't mean it's bad. So many may stick to it for the next 10 years. And if you go into the more complicated direction, and if you use Markowitz, yeah, it's used in Germany as well. You have a lot of transaction costs. It's a very, very academic model, which is not always useful in reality in the financial world. And it's not really successful from a performance standpoint, over time. I like risk parity very much. It has a bad press due to the bond market losses in the last years, but over the longer period, if you have a good structure, it's a good approach. And I think the main issue is in investing, the strategy has to fit the character of the investor. And by character, I mean the regulatory character as well. I mean, are you an institution? What are you allowed to do? Are you a private person? What are you allowed and what should you do? So there are a lot of aspects defining which strategy maybe fits your personality and your situation. So there is not one perfect allocation, but the bearable loss method, I think it's useful for everybody.
Yeah, when we think about asset. Oh, go ahead, Mark.
Sorry, I just wanted to mention. Very often, I hear, should I allocate to crypto or not? Yeah, or should I buy this or should I buy another token? But the most important question in investing is how much should I allocate? And so I think in this chapter, we did a lot of brainstorming on the right allocation. And I think that's really the holy grail. And as Jörg said, I think people are always disappointed when they hear these low numbers, right? 1%, 2%, 3%. But you have to keep in mind that it's a high volatility asset class, and also we're talking about huge asset pool. When we talk about the advisor in the US, it's $30 trillion of money, right? So you can't put suddenly 10-20% of that in crypto. That doesn't work. Yeah, we don't have the liquidity. And so really it's about, the most important thing is, has to fit your own character. But generally speaking, people will be surprised that really low allocations have an impact. And then it's an asset allocation where you can stick to it. Because the worst thing is performance chasing all the time. Yeah. FOMO in. Yeah. Suddenly you have too large of an allocation. Then the market is crashing, and then you're selling at the bottom. Yeah. I mean, I think you know the Dalbar study, yeah, where you plot the S&P return, and then they say, yeah, but nobody gets this S&P 500 return because of this FOMO and of this fear. Then at the bottom of the bear market, yeah, you're buying high and selling low, and if you have the right allocation, and then you can stick to it. Yeah, then you just do your rebalancing, and I think that's the best for most of the investors. Yeah, generally speaking.
In the end, I think the core of successful investing is not maximizing returns, but minimizing regret. So you minimize the risk of investing too much, and then getting out at the first drawdown. And if you don't invest at all, then you may fall prey to FOMO 5 years later, which may be as expensive as the other mistake, I think.
Yeah, I mean, listen, I think one of the chapters or one of the sections in the book is about behavioral finance. And I think this asset class is to the nth degree of what we've seen in traditional markets, right? As an advisor, you see a lot of these behaviors that have been, and that's the thing about this asset class that won't be different, I think, in the future or currently now, is that you're still going to have people investing in the asset class. So when you introduce the human element, you're going to start getting human behaviors, and you start seeing the rhyming of, all of the concepts of what you guys have introduced from a psychological standpoint. I think, yeah, that's important. I think one of the quotes you open up one of the chapters with was really important, especially when we talk about Markowitz and stuff like that, is, what was it? I think I had it here. Yeah, so advisors can create the best portfolios in the world, but they really won't matter if the clients don't stay in them, right? And that's kind of the approach. That's kind of the way we've built our approach to investing in our multi-asset actively managed strategy is, yeah. And that's the thing, the hurdle we have to overcome, because I think a lot of people, once they see that, oh, you're not just a Bitcoin or Ethereum, like you guys are going across the risk spectrum. Oh, you guys are probably just chasing returns. And it's like, no. We're actually trying to do the opposite of that, so that we can be a more disciplined, process-driven approach, being systematic with how we approach this asset class. And yeah, it's really risky, but again, that's why we exist, because we can go into these and take an approach that isn't that. But so I love what you said about those things. So I'd like to go into, I guess, the last section here. What I'd love to hear your thoughts on, because I didn't see a section on the book, but I'd love your thoughts on trust. I think before we hopped on, we talked about trust in traditional markets. And I think with the line we use a lot is the trust models of the future, and the way people trust financial institutions and intermediaries is going to change and evolve with technology. And we've already seen that happening. And we think the trust models of the future can be very different. I think that's why this asset class will exist, just for that, one of those core pieces. Walk me through your thoughts on trust and what that means in the traditional sense, and then also what it means for the evolution into this new asset class.
It's good question. I mean, my hope is, I think blockchain is the reason why you see a lot of financial institutions playing with it, or we have Bitcoin as a currency or store of value, is finance is very suitable for the blockchain, because it's not a physical thing. I think everything where we talk about physical things bringing on blockchain, it will be difficult being completely trustless, right? And so it's no wonder that we had this DeFi summer, right? Suddenly a whole new, I would say, sector in crypto, decentralized finance, yeah. disrupting exchanges, lending, borrowing, yeah, the whole thing. And now we have this buzzword, real world assets, right? We want to tokenize everything. My hope is that it will be based on some public, immutable, censorship-resistant blockchains, and not that every bank, every country has its own, permissioned, closed blockchain, because then that's not a blockchain anymore. Yeah, we have that. That's a database, a centralized database. And so I think we really have to take care that this will be the case, that public blockchains are used. I mean, make no mistake, there will be KYC and AML requirements. Yeah. I think in order for DeFi to be large and enjoying the adoption, we would like to see that you have this AML KYC component. But if we have at the end of the day, in a few years, 200 permissioned or thousands of permissioned closed blockchains, yeah, so every bank uses their own chain, I think that then we lost the game, so to say. Yeah, that's the reason why we also write this book, that people really at the beginning get familiar with this, the history of Bitcoin and the technology behind it, why it's important. And so we need digital bearer assets I can own. I think that's important. And so that's my wish. Yeah.
And I think I'd like to add, we have to differentiate between trust within the system, within the transactional world of Bitcoin and other cryptos. But if this works trustless, that's good, but it does not mean you don't need trust in the financial system. Of course, you need trust. It's a people's business. It will stay a people's business, especially in the advisor and the advisor realm, because the advisor has to trust his client, that the client is honest, talking about his, risk tolerance, his financial situation, his goals, and the client has to trust the advisor. So it's this world is still, trust is even more important than decades ago, and it's just a completely different story. Then the trust, the meaning of trust in this transactional world. These are two words, two completely different words.
Eloquently put. We couldn't agree more. So I guess the next question that comes to my mind then, so when readers read this book, what are you hoping they take away? If you had to label one or two things that you hope they take away from this book, what do you want them to walk away with?
I would love them to have an educated opinion on crypto assets, and not just to having an opinion without the education, right? That's the problem. As of today, everybody has strong opinions without having any idea about anything, right? And so you are welcome to hate Bitcoin and crypto assets if you've read the book and you say, it's still nothing for me, and Warren Buffett still hates it, and Jamie Dimon, I can accept that. But at least in order to make a financial decision, you should know what you're talking about. And I think if we achieve that, I think the advisors face really a problem now with the spot Bitcoin ETF in a positive sense, because suddenly they can invest. But I think what's missing in a large scale is a model portfolio, or what should the normal advisor do? Yeah. I mean, it's the same basic question. How much should I allocate? What should I buy? Is it just Bitcoin? Should I also add Ethereum? What should I do? Yeah, and all these questions, I think we handle in this book. And I think if we can help those people managing assets responsibly, also with crypto assets, then I'm happy, I would think. Yeah.
Yeah, I think if people read this book and decide that they don't want to invest, they still should understand why others do. Yeah, that would be great.
Exactly. Yeah.
Very well said. I love that. I've actually never heard anyone kind of come at it from that angle, Jörg, is understand there's value in that. There's value in, even if you decide you're not for it, understanding it helps you understand other people who are. And I think there's extreme value in that. And that is very well said. And so I just want to say thank you. We're coming to the end of of this session. I want to talk for the next 10 hours with you guys and go deep dive into each chapter if we could. So I'm going to have to bring you guys back, but take us through, when is the book being released? How can people find the book? How can people find you guys? What do you suggest people do? How can people find everything that you guys are doing?
Yeah, so the book will be out on January 24th. Is available on all the typical stores. Yeah, so definitely on Amazon. I don't know the other US stores so much. But it should be available everywhere where you can buy a book. There will also be an ebook. I'm also publishing on LinkedIn and on Twitter. So yeah, that's basically where you can find me. I don't know if you put the Twitter handle in your podcast, something like that. And yeah, we are also writing or started writing a Substack, right? It's called, I forgot the name, Jörg. Is it also Mastering Crypto Assets?
Yeah, it's Mastering Crypto Assets to make it easier.
Yeah. So that's also a source. Yeah.
Yeah, I think
Great.
Martin is a little easier to find than me. But my Twitter handle you can also put into the show notes. We got our website, perhaps everyield.com, where we put some information together, have a landing page for the book, and post some new stuff from time to time. That's
Wonderful. Well, gentlemen, thank you so much for joining me today. Thank you for sharing your intelligence, selling your experience. We need more people. We need more work that's done in this way. So just from us at Arbor Digital and myself personally, just thank you for all the work that you and all of the teams I know behind the scenes that are working tirelessly to make sure that something like this can come to life. Just a big thank you and big level of gratitude from us.
Yeah, thank you, Mark. It was really a pleasure being in your podcast. So also for us, we are very grateful. Thank you.
Yeah, thank you, Mark, for the opportunity.
Thank you for joining me today with my esteemed guests in discussing the intersection of conventional finance and crypto assets. I hope you found this episode to be illuminating and informative. To learn more about Jörg and Martin's work, their first book, or their upcoming book, Mastering Crypto Assets, please refer to the show notes. If you are gaining valuable intelligence from this podcast, please subscribe to our YouTube channel as well as to our podcast on Apple or Spotify, where you can also leave us up to a 5-star review. As always, don't forget to tell someone today that you care about them.